We have a Fed that don't know what they're doing. So for the record, sir, do you?
I would say let's take a look at the economy and let that be the report card. So again, the economy is into its 11th year of expansion.
The longest in modern history.
Since we kept records, which began, I think, in the mid-19th century. Unemployment is at a 50-year low and has been for 15 months, and we expect that to continue. So, I think inflation is below where we'd like it. As you know, we're concerned about uncertainties and other factors that are weighing on the outlook and looking at changing our policy. But overall, I'd say that our economy is on a solid footing.
So, despite disagreements you and I may have had in the past about the actions I think the Fed should have taken with respect to interest rate raises, I want to state for the record, I do think that you know what you're doing. I thank you for being here. I thank you for your willingness and courage to stay independent. I thank you for your accessibility. You're only the third Fed chair that I've had the privilege to work with, but you're amazingly accessible. And I thank you especially for your remarks earlier in conversations with various members, notably Mr. Stivers and Mr. Perlmutter, regarding wage growth, and in particular, not being tempted to characterize recent wage growth as adequate, because it isn't adequate. And as you know, I've been asking since I came to this committee, when does America get a raise? And it's long overdue. But it sets up a bit of as it were, a dilemma for me. You have characterized here today that the cross currents confronting the American economy are trade and global growth. I want to know why it is, given that the Fed and you have accurately pointed to the fact that our economy is 70% consumer driven, why hasn't the Fed called out more than a generation of lack of wage growth a threat to this economy? If we want to have a healthy economy that is 70% consumer driven, we've got to have some decent wage growth, and we haven't. We have to have a prosperous, growing middle class, and we haven't. So why doesn't the Fed explicitly call out this lack of wage growth as a threat to the growth of this economy and the health of this economy?
Well, I think we do. I mean, I think we've been trying to promote.
You were asked, and you said the cross currents are trade and global growth. The other cross current, the other downward factor, is the absence of wage growth. Is it not?
I think it's really, if you look at go back to your point, go back to the turn of the century, what you saw was a decline in labor share. So, and that has not been reversed. So we're focusing on the change in wages, but really the level, they're missing, wages are missing 10 years of growth. So I think that's really the underlying problem. We're getting reasonable wage growth, but we missed all of those years beginning again at the beginning of this century. So I think it's a very serious problem, and we should do a better job of calling it out.
I look forward to you doing just that. Phillips curve. There was a recent article in the Wall Street Journal said that in Japan, the Phillips curve is dead. And obviously the connection, as was discussed here, or alluded to here earlier, has become more tenuous even in this country. I would posit and ask for your reaction that the fact is that if you measure the Phillips curve in terms of U3, the connection's been more tenuous. But if you do, as you just now indicated, in terms of percentage of especially 25 to 64, 25 to 54-year-olds participating in the workforce, then the Phillips curve isn't dead, and that's in part why we're beginning to see some traction. Why would we continue to use U3 when it clearly isn't reflective of what has gone on, especially in the aftermath of the Great Recession, where people keep coming out of the woodwork to join this workforce, and as a consequence, that unemployment rate keeps going lower and lower, but we keep adding hundreds of thousands of people to the workforce. Is it not? Have we repealed the law of supply and demand, or can we, if we continue to add people to the workforce, expect continued wage growth?
So U3 is just a number to us. It isn't the number. We refer to it quite a bit, but obviously we look at a broad range of employment indicators. I'm not sure I took your question though on this.
Well, I think my point is that we haven't reached full employment as long as people keep coming out of the woodwork.
Okay, that's where I thought you. Yeah. So I mean, that's what we're learning. We're learning this. A lot of the margin where we've seen the improvement has been in labor force participation rather than unemployment, and that's great. People come in, you could actually see, and you have seen in some months, you've seen labor force participation go enough labor force participation increase that the unemployment rate actually ticks up. That's a good thing.
So I'm way over, and the chair indulged me to even allow me to ask questions today again, for which I'm grateful. Two things: we need more wage growth. Secondly, I believe you know what you're doing, sir, and I thank you for it.
Thank you.
Thank you very much. Mr. Powell, we have one more member, the gentleman from Georgia, Mr. Loudermilk, and then we will wrap it up.
Thank you for your indulgence, Madam Chair. Chairman Powell, thank you. I will try to be quick and concise. I do have just a few questions, and so I won't make any statements. The first one, real-time payments. You and I have had this discussion before. When do you have any idea when you may announce the decision of whether to get into real-time payments or not?
We're in the middle of we haven't actually gotten to a place where we're getting ready to make a decision, but I think there's been a ton of work, and so we're moving forward to try to make a decision, when it's ready to do.
Okay. What are the factors you're weighing?
So this, as you know, this was something that came out of the Faster Payments Task Force, and that was a group of involved, small banks, large banks, community activists, technologists, card companies, all of that, and there was broad support, particularly among the smaller banks, as I mentioned earlier, for us to play a role in final settlement, and that was a recommendation that came out of that. So we put out a proposal last year. And we asked for comment. We got, I think, 400 comment letters, and we're piling through those and working our way through assessing the issues. We have to look at two things. One is just the requirements under the Monetary Control Act, and there's also just a big policy question, which is there a role here? There are people who feel strongly that there is a role here for us, and there are others who feel not. So we're having to make a decision on that, and we'll be doing that.
Okay, I appreciate if you keep us in the loop on that. We have several parties, especially in Georgia, very interested in the direction you're going. And so another issue regarding the tailoring of proposals or the tailoring of regulation for domestic and foreign banks. Now that the comment period's closed, when do you expect final rules on that to be issued? Well, the tailoring of regulations for domestic and foreign banks.
Let me look for domestic and foreign. Okay, so. Yeah. The comment period for domestic, and I don't have a date for you. I know
I think the comment period is recently closed. I'm just wondering. From my understanding, the comment period recently closed on that. It's just
foreign it closed in June. For domestic, it closed in January.
Okay.
I have to come back to your office on. I don't know what I mean, I think Vice Chair Quarles said that we see most things being wrapped up by the end of the third quarter, and darn near everything wrapped up by the end of the year.
Do you anticipate the domestic and foreign will be done together?
I don't know.
Okay. With the remaining time, one other issue that's important, especially back in Georgia, small dollar lending. When the FDIC Chair McWilliams testified back in May, I asked her if they plan to address a small dollar lending issue for banks, and she said that she was going to work with the other regulators to get this done. Is the Fed committed to working with the FDIC and OCC to come up with a plan for the small dollar lending?
I think we're doing that, actually. I think there's an interagency group that's carrying that forward right now.
Okay. With that, I think we're all ready to end a very long morning. So I appreciate that. And Madam Chair, thank you for your indulgence, and I yield back.
Thank you very much. I'd like to thank Chairman Powell for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair. which will be forwarded to the chairman for his response. I ask you to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is adjourned, and I thank you very much for your patience, Mr. Powell.
And that is Fed Chair Jay Powell wrapping up his day 1 of 2 days of testimony on Capitol Hill today. Welcome to the exchange, everyone. I'm Kelly Evans, and the Fed chair not taking a rate cut this month off of the table. Markets have been moving big time as they digest everything he said in his prepared remarks and then throughout the question and answer portion of this testimony today that just wrapped up. We'll get to all of those market moves. First, let's bring in Steve Leisman. Steve, with the biggest headlines from this, I mean, the fact that, look, he even had a chance after he saw those remarks cross at 8:30 to water things down. And he didn't appear to do that at all.
Not only take it off the table, think about, like, the serving of the turkey. He brought a very large turkey of a rate cut. I'm not saying the rate cut itself was a turkey, to the table and said, here, eat this. He was asked, Kelly, directly by a congressman to the idea of trade uncertainty and low inflation, those two factors, does that mean you should lower rates? Here's what he said.
Yes, as I mentioned, we think that uncertainty around trade policy and also global growth, it's not all down to trade policy. There's something going on with growth around the world, particularly around manufacturing and investment and trade. And so that uncertainty is we think, weighing on the domestic economy.
As Kelly said, not only from the report, but also in the testimony, he accentuated the negative on a bunch of things. Let's go through them. The jobs report, really strong jobs report, did not change the outlook. Data since June has continued to disappoint. Concerns about global economic weakness and trade uncertainty remain. Look, he had no intention at all of walking the market further back from its belief that a rate cut is coming. In fact, it's like he pushed them a little further down the road.
Which is fascinating because think of what's happened since we last heard from him. Last Friday, we got the jobs report for June, and it was extremely strong. 224,000 jobs added, way above expectations. There had been softness in the ADP survey. There had been softness in some of the other sentiment surveys. There was no softness really in that report. And the big question, and you saw people then price out the chance of a rate cut.
Of a 50 basis point rate cut.
50,
but they left 25.
And then, Steve, within moments of his testimony crossing the wires this morning,
boom.
And as you've seen every hour since, there's somebody else out there saying.
The markets reacted instantaneously.
And a half-point rate
yield
cut.
fell. Yeah, it was quite extraordinary. A little bit. I got a 23% probability, but you're right. It was like 3 percentage points. I'm curious as to his thinking here. If I were a policymaker in his shoes, I would want to claw back a little flexibility, unless, and he knows this better than anybody, he's got the entire committee on board, and they're just like sort of salivating to cut rates right now. If that's where he is and that's where the committee is, then he's okay in this kind of transparency. But he does not have any flexibility at this point unless the data outperforms.
And that would have been Friday.
Expectations.
Let's kick this around a little bit more. Stay right there. Also joining us now is Michelle Meyer. She is head of U.S. economics at Bank of America Merrill Lynch. Craig Callahan is president of Icon Advisors, and Brian Reynolds is chief market strategist at Reynolds Strategy. Guys, it's great to have you all here. And Michelle, you guys, in the wake of this, correct me if I'm wrong, now have moved up that rate cut forecast to say, yeah, it's going to happen at month end, right?
That's right. We were kind of on the fence, looking at the data, assuming that strong jobs report, ISM above 50, would allow the Fed to have a little bit more time to assess conditions before making the move. But Powell very much suggested the otherwise today. I mean, he made it very clear, as Steve said, that this is a Fed that is looking to act. They're very worried about uncertainties, and they're looking at a broad range of data, mostly global data, in terms of informing this view. So to me, I think a 25 basis point cut seems very likely. In fact, there's a decent probability they can consider a 50 basis point cut. They want to be aggressive, they want to be early, and they want to ensure that this is a recovery that can continue, and they're not waiting to see evidence of slowing in the data.
Craig Callahan, I know that you think that they tightened too much last year, but I want to talk about the why they're doing this. Do you agree that the outlook is so gloomy that it justifies a half-point rate cut at this juncture, or should they be focusing more on the inflation story and saying, look, the growth numbers aren't that bad, the jobs trends aren't that bad, productivity is picking up, that's actually good, inflation's low, that's actually good. Does the mixed messaging, how is that going to play out in markets, do you think?
the inflation outlook is just so moderate. There's no inflation in sight. So
Right.
they have plenty of freedom to reduce federal funds, stimulate a little bit without any fear of inflation.
Without it, absolutely. But my question to you, and I know that you're long equities, is should people be long equities? Should they be long, especially bonds, Craig, when the fundamentals for growth, for example, aren't that bad? I mean, the yields, I mentioned this earlier, but some of these European corporate junk yields are negative now. I mean, if the justification for yields being as low as they are is that, oh, well, the German economy is weak in the ECB. I mean, is the growth outlook in the U.S. really that bad? Are people all piling in way too far on this bond trade?
Well, we're value investors, and we find stocks in the U.S. to be about 15% below our estimate of fair value. So we see stocks as cheap and bonds as very expensive.
All right. Very simply put. So, Mr. Reynolds, you've been saying the markets for a long time have been pushing the Fed to be as dovish as they are right now. Does this then unlock a path to higher stock market valuations? And what do you think about bond valuations right now?
Well, I've called this the all-weather stock market because when the Fed was raising rates in October, stocks hit an all-time high. Now market rates have been coming down since December, and the stock market hit all-time highs in May, June, and July.
Right.
So the real thing that's driving this is financial engineering, and we're going to be getting more of this because while the Fed is on track for a rate cut this month, the bigger issue is that money market and financing market investors are telling the Fed to cut even more. They're telling them to cut 5 times in the next 12 months.
Wow.
That's the big issue, and the Fed is not ready to do that yet.